Are we heading into a recession? Did we ever really come out of the last one? Do market fundamentals matter anymore? How did Democrats miss so badly on the economy, leading to the re-election of Donald Trump? Is capitalism collapsing? You know, it's difficult to get a proper read of the US economy. It's a giant, complex juggernaut that both relies on global markets and holds them all together. And there's no unifying economic or political theory to provide clarity as the biggest economy in world history continues to navigate uncharted territory. So today's episode covers a lot of ground. So what I'm going to do is periodically drop in some dad jokes to lighten the mood. And by the end of this, hopefully you'll see why Donald Trump's policies might be worse than previously imagined. UNFTR. All right, so for an even more detailed version of this, head over to unftr.com to read the corresponding essay or download the podcast. And while you're there, you can sign up for our free weekly newsletter where we share important articles, essays, profiles of progressive leaders, fun facts, charts, graphs, musings, and more. It's a must-read, free, did I mention it's free? Weekly newsletter for leftists and progressives. Now, without further ado, I've wanted to have this discussion for a while because there are concerning signs on the eve of another Trump administration. So here's how we're going to break it down today. We'll start by level setting with some assumptions, or assertions really, points that we need to agree on to move forward before delving into an economic analysis. I've also asked a good friend of mine in the industry, whom I trust, to weigh in on key points further in the episode to kind of keep me honest. I think you'll appreciate the exchange. Now, with that said, here are the fundamentals that we have to agree upon in order to move forward. The stock market is not the economy. The United States economy is the global economy. Market-based economies are cyclical by definition. The rate of change in the labor markets is faster than at any time in history. Inequality is a condition of capitalism, and rampant inequality leads to social unrest. Sentiment is just as powerful as any data point. The single biggest economic force is greed. All right, so let's take them one by one. You know, oftentimes our corporate media culture conflates the stock market with economic health. So when the market crashes, it's presumed by many that the economy is out of balance. Likewise, when the markets are ripping, there's a sense that everything's okay in the world, even when it might not be the case. So while they are related, they're not directly correlated. Equities have been on an unstoppable run since the 1980s, when changes to the tax code were first introduced and stock buybacks were legalized. This was followed by changes to executive compensation in the 90s that tied tax rates to performance metrics, thereby incentivizing the corporate class to reduce executive wages but artificially boost profits so that they could be taxed less on the profits and the performance of the companies. So, in the aughts, investors had more asset class options such as real estate. What happened was the Federal Reserve brought the federal funds rate to a low of 1% in the middle of the first decade of the millennium and encouraged speculative behavior. This led to massive capital inflows into several parts of the economy, like real estate. Then, the Fed reversed course and over the next 5 years quadrupled rates, which hastened the subprime mortgage collapse. Then, at the start of the Obama administration, when he tried to put everything back together, rates came down to effectively zero, followed by several years of quantitative easing to salvage the banking industry. The net result of this was a massive influx of free money into the financial system, and equities haven't looked back since that time. In fact, the stock market gains over the past 15 years are bigger than at any time in history, and it's not even close. And yet, these gains haven't been felt in the wider economy. Do you know why oysters don't donate to charity? Because they're shellfish. There are two economies that matter in the world, the US and China. Now, if you read the headlines or watch the news, you might be fooled into thinking that China is about to overtake the United States. The dollar is going to be replaced as the world's reserve currency, and that we should all be studying Mandarin. So again, for posterity, the U.S. economy is 40% larger than the Chinese economy. We're growing and they're slowing. Our population is around 350 million. Theirs is 1.4 billion people. They have 1 billion more people than us. It's not even close. Also, we're China's #1 trading partner. Without our purchasing power, it all falls apart for them. We are it. We're the biggest. Happy now? I could go on for days about how we do not exist under a pure capitalist system, but rather a perverted form of oligarchic state-sponsored capitalism. I won't, but I could. Anyway, over the past 250 years, we have operated under a market-based economic system. The whole world has. This is the opposite of the pre-industrial closed feudal system. So all those isms that we talk about are related to social doctrines with economic overlays, like how capital is organized and distributed, and not the underlying theory of markets. So socialism, communism, capitalism, libertarianism, and everything in between, they're all organized around the principles of markets: buyers and sellers, producers and consumers. As such, cycles are inherent to market systems: early, growth stage, peak, decline, and late stage. And there are fundamental characteristics to each one of these phases. What politicians and economists try to accomplish is to mitigate any negative effects of each stage through a complex system of carrots and sticks, incentives and disincentives. These show up in the form of interest rates, tariffs, money supply, and government investments. But the cycles themselves are a reality of the market-based system. So the question at any given time is, where are we in the economic cycle based upon certain indicators? Now, not everyone shares the same view of where we are in a cycle, and weeks, months, and years make a huge difference. Which levers should be pulled is also a matter of opinion based on past indicators and estimates and guiding philosophies. Moreover, these past indicators aren't foolproof, as the underlying conditions change over time due to factors such as population growth or decline, access to natural resources, geopolitical forces like war and social unrest, policy changes that impact supply chains, interest rates, commodity prices, and the like. And of course, the biggest modern X factor, climate change. So as much as markets are fundamental to the global economy, they're difficult to predict and impossible to govern. But one thing is certain: what goes up? Okay, I'm going to have to make the case for this one because it is a departure from historical norms. And we've written at length about Schumpeter's theory of creative destruction, so bear with me here. Essentially, technological changes create upheaval in the labor market over time. The most classic example of this is the rapid evolution from the horse and buggy to the automobile. While it was a seismic change that continues to yield enormous consequences to this day, the transition occurred over a few decades. So, the saddle makers became brake manufacturers. The stable owners opened warehouses. Buggy and whip makers became auto parts manufacturers, and so on. Now, importantly, the actual people didn't change their professions. I think the idea of reskilling and retraining is largely fallacious. What really happened was that the labor force turned over across 1 or 2 generations, depending upon the impact of a particular innovation. My contention here is that the impact of AI is just beginning to emerge and holds potential to upend the labor force in unprecedented ways. I mean, it's only been 2 years since the launch of ChatGPT, and it's already changed the way many of us work. And at a minimum, it's changed the way we view work. Because we've moved to a service and knowledge economy, the rapid adoption of artificial intelligence will have enormous consequences across multiple industries. Entire swaths of mid-level functions at first, and then higher-level functions as the technology improves, will just disappear. Now, in the past, we've seen supporting industries appear to facilitate the technological disruptions and replace the outmoded industries. Like, I started out in the radio broadcasting field, and then I went into the newspaper business. What a futurist I am, right? So I do know a thing or two about these kind of transitions and the disruptions that occur. But this time is different. Now, radio was replaced by satellite radio and then Pandora and Spotify, but the creator economy grew and diversified as a result. And over time, the labor force shifted. News and information went online, and web development jobs took the place of print shops and distribution channels. I'm sure mechanics who can fix a combustion engine will be around for a while longer, And when there are no more gas-powered vehicles on the road, there still will be EV mechanics and manufacturing plants, makers of charging stations, and so on. But in the knowledge and service economy, we're going to see something different. Productivity rates will skyrocket in the next few years as AI is infused into every single process and at every stage of a traditional buyer's journey. And then what? We will learn to do more with less. More work with less employees, that is. There will be no AI bot service centers. Coding jobs won't be replaced by ChatGPT prompting jobs. That's a very childish observation. Point being, this is going faster than we realize. And the generational labor market turnover is going to look more like a turn under the till and churned into the ground. Now we get into the socio part of socioeconomics. Conservatives think inequality is just sour grapes. They think our system works just as it should, and that financial rewards are just the way it is. Work hard, get paid. America's the land of opportunity. Now, we've dispensed with this logic from day one of our podcast, and there's more than enough data, research, and information out there to debunk this. But inequality in America has led to something more than haves and have-nots. The corporate colonial system we live under today has ripped apart the social and political fabric of our democracy. Decades upon decades of deregulation has allowed the plutocrats in charge to change the rules of the market system. They get free money from the Treasury and pack it into investment vehicles with guaranteed returns, and when those returns don't show up, they get bailed out. They've upended labor protections and social welfare programs that protect the poor and working classes and have taken control of the levers of political power. They've turned the masses into wage slaves and are determined to strip away the last vestiges of social programs designed to undergird the working class. So inequality is an inherent characteristic of market-based systems. It's the social theories that differ in terms of how to handle it, like who owns the means of production, the rights of workers, whether healthcare is a right or a privilege. Does the justice system exist to protect property rights or people? Those kind of things. When a society reaches the limits of inequality, such as that we're experiencing right now, whether it's under the thumb of a corrupt despot or the corporate colonial state, the social contract unravels, and that can lead to unrest. And as we've said before, social unrest is one of those conditions that can upend all pure economic metrics. Why don't some couples ever go to the gym together? You know what? Some relationships don't work out. Donald Trump is the president again because the Democratic establishment ignored the sentiments of the masses. Americans are stretched thin and stretched out, and the Democrats acted as though nothing's wrong with the system. Likewise, when consumer sentiment collapses, which can happen for any number of reasons, it creates a contagion of fear that becomes a self-fulfilling economic prophecy. Adam Smith, David Ricardo, Karl Marx, John Maynard Keynes. The reason these figures continue to loom over the field of economics is that they understood human nature and the impulse of greed. Adam Smith may be a curious entry on this list because his legacy has been reduced by conservatives to the father of capitalism and the invisible hand. But as John Kenneth Galbraith wrote of him, Adam Smith is far too wise and amusing to be relegated to conservatives, few of whom have ever read him. End quote. For if they had read Smith closely, they would immediately recognize his antipathy toward corporations specifically and their predilection to rapacious behavior. These great economists who endure are, as individuals, greater than the sum of all contributions before or since. So many theories that we rely on today, whether it's Milton Friedman's belief that corporations exist solely to maximize shareholder value, Ronald Coase's eponymous theorem that markets resolve friction better than governments, or the neoliberal extrapolation of the Laffer curve that states that tax rates stifle innovation and returns, are just that, theories. Ideas that support the unmitigated abundance of the corporate class and fall apart in the real world. All of them fall apart due to the overriding force of greed. If we think back to that time of transition from the post-Keynesian Galbraith era and the neoliberal Chicago era, there have been several technical recessions: 1973, 1980, and 1981, 1990, 2001, 2008, and 2020, all of which occurred in my lifetime. This is defined as 2 consecutive quarters of negative growth and is thereby called in retrospect. So with the benefit of hindsight, we can pinpoint reasons for each of these, ranging from cycle norms and oil shocks to the housing collapse and the global pandemic. Now, it's always difficult to see these things clearly in the moment, but what's instructive is how our response to them has changed over time. So when I look out over the economic landscape on the eve of Trump's second term, I'm as baffled as I am concerned. It's not entirely clear to me, for example, that we ever even made it out of the financial crisis. And I'll give some more reasoning for that below, but if that's the case, then Trump's platform would be nothing short of catastrophic because it will tear safety nets to pieces. There's nuance to every economic cycle, and there's only so much historical trends can tell us about modern circumstances, especially given the pace of change in the workforce due to technological innovation. But there are 6 objective trends or macro data points that typically tell the story of where we are in an economic cycle. So I'm going to go through each one of them and give you 2 takes. My take and that of a friend of mine who is a macroeconomic financial analyst who shall remain nameless. But I really trust his perspective, and he's a good gut check for my pessimism. The first is labor. The labor headline is typically about the unemployment rate, but here's the issue with it. The unemployment calculation is the number of unemployed divided by the labor force and multiplied by 100. Great. The contentious part of this number is the definition of the labor force itself, which is defined as the civilian population above the age of 16. Curiously, there are no age limits as to what people consider retirement these days, so everybody is technically in the labor force if they are actively seeking employment or currently employed. So those are the 2 important parts of labor force. You're either currently employed or you're actively looking. Incarcerated citizens, members of the military, enrolled students, anyone who isn't actively seeking employment for more than 4 weeks is considered outside of the labor force. So that takes a huge swath of the population out of the mix. Now, importantly, this figure also includes part-time and gig workers, which make up about 17% of the workforce currently. What's the best thing about Switzerland? I don't know, but the flag is a big plus. There are reporting and classification problems with the unemployment rate, but it does make for a useful headline talking point to kind of generally put a finger on the pulse of the nation. But economists look more closely at something called the labor participation rate. This is a measurement of those who were 16 and over, non-institutionalized, and employed or actively seeking employment as a percentage of the total population. So who's working and who wants to work? Now, here's where my friend and I differ a little bit. My glass half empty stems from a historically low labor participation rate. Right now, the rate is around 62%. Now, it did recover from the shock of the pandemic, but it's since leveled off, and that's concerning. The last time we hit a rate this low was the early 1970s. That said, the highest this number has ever been was 67% at the turn of the millennium. Even still, though, we're talking about millions of people. Now, on the flip side, here's my friend's response to this. Yes, the labor market has aged significantly, and the retirement of baby boomers is a primary driver of the sustained low LFPR. While the overall LFPR is historically low, the prime age workforce participation rate is a better measure of the labor market's vitality. It reflects the active segment of the workforce without being skewed by demographic trends like aging. As such, focusing on prime age participation gives a clearer and more actionable understanding of labor market conditions. All right, so if we take his preferred vision of the prime rate of workers between the ages of 25 and 54, we are near an all-time high, around 83.5%. This is a double-edged sword. This number rose rapidly under Reaganomics as more and more households were forced to move from one-income to two-income families. Now, I'll let the sociologists hash out the upside and downside of this, for example, female empowerment in the workforce, but it is worth mentioning. But here's my bigger takeaway. Boomers are expensive, and they're retiring. So here's the math problem we have. The average household savings among boomers is $289,000, which means half of them have less than that. But inflation's been chipping away at living expenses, healthcare costs are rising, and end-of-life care is way beyond reach. So many of the boomers also rely on Social Security and Medicare or Medicaid, but even without that, even with health coverage as it is today, the cost of living outside of that is growing rapidly, and it's exceeding income from investments in Social Security. So as the boomers age, the responsibility is going to fall to Gen Xers to fill in the gaps. And here's the problem. The average Gen X household has only $82,000 in savings. Okay, so ISM manufacturing data measures sentiment among manufacturers. And ISM manufacturing data has yet to recover. Now, this is perhaps the most authentic recession trend figure that exists. So if you zoom out to look at the trend line over time, the data have been steadily depreciating over the past decade. This essentially measures the health of the manufacturing sector, and it's pretty black and white. What it tells us is that the overall manufacturing sentiment remains soft compared to nearly all prior cycles over a 50-year period. In fact, the only time ISM data was at this level in prior periods was during the recessions. But here's what my buddy had to say about that. ISM is a survey-based measure. Not only have the participants not been as willing to talk as they were in the past, the financialization of economic data is skewing the results of the survey to a more negative tone and are clearly not indicative of what is really happening in the economy. The world has changed and ISM has not. Okay, good point, counterpoint. Fine. However, a willingness to talk or not talk doesn't skew the data. It just reduces the sample size, but it's still enough to have a statistical sample that matters. Now, I'll concede that a survey-based measure isn't as precise as hard and fast figures, but you can't diminish the importance of sentiment, even if it's just among a manufacturing class. The fact remains that ISM has been a consistent indicator of recessionary trends over a long period of time, and the numbers are stubbornly depressed below cycle norms and have been for a few years. In other words, manufacturing would appear to be stuck in some sort of late-stage cycle, but things might be a little wonky because the stages were all upended by the pandemic. So here's what I wrote to him about debt. Household debt is at unprecedented levels. Hard stop. Student debt is also unprecedented. To which he responded, "Don't get me started on household credit. Yeah, the levels are higher, but that is meaningless. Household credit needs to be evaluated relative to incomes and total net worth. What if I told you household debt service payments as a percentage of disposable personal income is lower now than it was 11 years ago? Interesting stuff, right? Well, I would say two things. Number one, fair point. But more importantly, 11 years ago was 2013, and we weren't in great shape then either. Debt service relative to disposable income being less than that period is a positive indicator, to be sure. But what happens when the cycle flips and we head into a downturn? Interest rates remain high, so refinancing isn't an option, more people are out of work, and debt is still at a peak. Give up? Well, I believe that the answer is a consumer debt collapse similar to the housing collapse, but more distributed, but because it'll include the 35% of Americans who rent. Now, it won't be as deep as the housing crisis because you're talking about the primary wealth-building asset that most families have in this country, but it will be more widespread. And if it happens on Trump's watch, do you think they'll come to the rescue for the working class like they did for the businesses in the pandemic? Do you think that they'll send checks to individuals so they can buy food like Trump and Biden did during the pandemic? Something makes me think that they won't be as sympathetic to a crisis that they'll ultimately blame on the people for having too much debt. The narrative will be the same as it was coming out of the housing crisis. It was the working class that got too greedy and lived beyond their means. Here's my thesis on inflation. Inflation is cooled, but the cumulative effects means that prices remain elevated in the face of stagnating wages, thereby continuing to pressure household budgets. And here's his response. Yes, inflation was not transitory, and price levels reset 22% higher today than versus 2019. And while inflation is now much cooler, we still had this huge price level increase. It is never going back down, absent a depression. This is why Donald Trump won. So the upside here is that we pretty much agree. The downside is that we pretty much agree. I've been reading this book on anti-gravity. Man, it's impossible to put down.
I'm joking.
So against all of this backdrop, the incoming Trump administration is signaling a few troubling policy changes. The first is his tax policy. The CBO estimates on his plan indicate that taxes will be slashed for the top 1%, but will actually increase for almost everyone else. Mind-boggling. This will have the intended consequence of boosting the equity markets for the short term, but it won't last, and I'll explain why later. Companies are already dealing with inflated shares due to stock buybacks, as evidenced by elevated PE ratios on the S&P that are inching back toward recessionary highs. Yet another reminder that a hot stock market is oftentimes the ultimate false positive. So my friend said, on your last question, yes, I think the equity market is expensive, but profit margins for U.S. companies are 20% higher than they were 7 years ago. Companies in the USA are the best the world has ever seen. Innovation, investment, professionalism, energy independence, plus having low-cost production in our neighbor Mexico is a huge plus. Europe kneecapped themselves with overly generous benefits and a social agenda, including green energy, which has destroyed their industrial base and eroded entrepreneurship. American dominance over the last 10 years is completely astonishing. Okay, so I will concede a lot of the factual sentiment of his response, meaning the U.S. has pulled away from the pack. We are way more dominant than the rest of the world. I agree with his assessment of the European economy, differ slightly on the whys and the wherefores of it, but I'll just take it at face value that his overriding opinion, his overarching theory here is that we are so much more professional than the rest of the world and so dominant as a business culture that it's a good thing that profits have risen 20%. And this is where our opinions diverge perhaps the most. You see, his is very much the economic lens of a financial market analyst, whereas I view the world through a socioeconomic lens. So he's looking at the health of corporations, and to be fair, not just the big ones. So we took the conversation offline and talked through this on the phone for a bit, and he made the point that most corporations are small businesses, and therefore increasing profits is good for more than just Wall Street. Fine. My contention is that even these profits are not distributed enough through the whole economy, as evidenced by stagnating wages, wealth inequality, increasing debt thresholds, and general precarity that did indeed deliver us Trump 2.0. So if corporate profit is your primary measuring stick for the overall health of the economy and society by extension, then your measurements, my opinion, are built on falsehoods. All right, so this brings us to the last indicator, energy, one of my favorites. Because crude oil remains the most ubiquitous energy source and it's priced on global exchanges, to me it's the best indicator of global demand. And for the past couple of years, even through the supply shocks that trailed the pandemic recovery, oil prices have been depressed. Moreover, they remain lower than early cycle recovery and mid-cycle periods despite ongoing OPEC supply constraints. So this is partly as a result of the sluggish Chinese and European economies for sure. And while gas prices may feel manageable at this moment, this is actually a negative sign, specifically because the oil cartels are trying to hold back supply. So this demonstrates that the demand for energy is even more depressed than the prices suggest. So this is actually what prompted us to take the conversation offline. This is the one indicator that really gave him pause and required more discussion. Because on the one hand, it's a negative indicator of global demand, so that's a bad thing, right? On the other hand, it's coming at a pretty convenient time because energy is one of the main components of inflation. So it's having a positive effect on the consumer, or at least it's holding it in this precarious balance. But again, my contention here is that consumers are close to the edge as it is. So let's assume that the economy heats up under Trump, which we'll talk about in a second. If prime age labor participation is near all-time highs, and inflation is 22% higher than pre-pandemic levels, then any uptick in energy consumption will spur an increase in oil and gas prices. So the inflationary cycle would then theoretically resume. So enter Donald Trump again. Let's take 3 of his core policies at face value, just 3. Taxes, immigration, and tariffs. On taxes, even my friend concedes that further tax cuts for the wealthy won't stimulate the economy. See, there's a difference between cutting corporate taxes from 35% to 21% like he did the first time. This stimulated wealth growth among business owners and shareholders, but as we know, it didn't trickle down to help wage earners. Cutting another 3% off corporate taxes will do even less. But the real kick in the teeth is that Trump's proposed tax plan will decrease personal income taxes of the top 1% and increase taxes on the vast majority of American households. On immigration, forget the moral and ethical horror show that Trump's mass deportation plan pretends, and think about this in a cold and clinical economic manner. If we're at record highs for prime labor force participation, but there are nearly 11 million undocumented immigrants with gainful on and off the books employment, then what happens when you suddenly remove tens, if not hundreds of thousands of low-wage workers from the labor force? And what happens when you chill immigration at the border, because it will have a chilling effect on those trying to get to the country, right? I mean, the same thing that happened after the pandemic when the economy ran so hot in the recovery that it was impossible to find people to fill low-wage positions in hospitality, healthcare, retail, agriculture, and certain service industries, right? So what happens then? Back to work, grandma? In fact, one of the dirty little secrets Democrats didn't want to admit was that the influx of migrant workers was partially responsible for suppressing wages, which in turn held down inflation. That's why, even though inflation was high in the United States, it was still lower than in most other developed nations over the same period. And what about those tariffs? Trump's tariff plan will absolutely incentivize manufacturing in the United States over the long haul. But people are waking up to the reality that this will wreak havoc on the economy in the short term because the increased cost of goods will be borne by the American consumer until such time that a domestic supply of goods can fully replace them. And that takes years. So perhaps his brain trust can point to that time that Nixon did the same thing in an attempt to strengthen the dollar. And the result was catastrophic. It was called stagflation. And it didn't take a lot of time to drive up inflation, by the way. Of course, this was combined with an oil crisis because of unrest in the Middle East, but oh, wait. Now, look, I can go on and on, but even just a few quick examples, like if this administration goes through with its promise to eradicate all federal student loan programs and throw student debt into the private sector, default rates are going to skyrocket. And if Elon and Vivek convince Trump to eliminate tens of thousands of federal workers, where the fuck are these people going? I mean, Ramaswamy is actually on record saying that it will give these workers the nudge they need to transition to the private sector, but to do what? I mean, he's talking about this like it's a positive thing. So here's the upshot. As much as I love the back and forth with my friend, and I love talking about this stuff and theorizing about it, and I value his opinion on financial markets, I feel he projects unwarranted optimism founded in my very first principle. The stock market is not the economy. Our state-sponsored capitalist system has been working overtime to prop up the corporate class through bailouts and low-interest loans at the expense of the working class for decades now. Multiple bailouts, rampant deregulation, cheap money, and tax cuts has hollowed out the core of the economy. Market gains are kind of phantom gains, and we didn't even touch on the housing crisis. I mean, so much of our wealth as citizens is tied up in housing, which excludes vast segments of the population. And prices are so inflated that accessing this equity is nearly impossible because there are fewer and fewer places to go after you sell your nest egg. So at a time when things are, by all objective and historical measures, incredibly precarious, one false move could bring the economy tumbling down. So what happens when several false moves are made? I truly feel that we're living in a massive bubble of inequality, precarity, and personal debt, and that we just elected the one person who's holding the pin and is willing to pop it. Here endeth the lesson. Hey, thanks for watching the video. Honestly, I can't believe you made it this far. I fell asleep editing it hours ago. But while you're here, Don't forget to sign up for our free weekly newsletter at unftr.com. And while you're there, you can browse our directory of progressive resources, check out our archive of original essays and podcasts, read our progressive spotlights, and maybe, just maybe, sign up to become a member of the show, like these wonderful human beings who support our work.